Hello and welcome to this episode of Inside the Research with iCM. I'm Pete Seiler, part of our business development team here at iCM, and I'm joined by Ryan Lehman, iCM's Director of Investments. Ryan, thanks for joining us.
Happy to be here, Pete.
All right, so with all the volatility swirling around markets today, I thought it would make sense to share some of our thoughts from the investment team, and in particular, what strategies you recommend for advisors and their clients in times like these. So on that note, why don't we start off with a look at equity markets?
Yeah, sure, Pete. So it's definitely been a wild ride for equity investors so far in 2025. And in all reality, though, it probably feels a little worse for investors than where we actually stand today. And the reason I say that is on April 8th, so just about a month or so ago, the S&P 500 was pretty much a stone's throw away from a technical bear market. And a bear market's just going to be defined as a peak to trough decline of 20%. That said, though, we've recovered just about all of those losses over just the last month, and this was largely driven by President Trump's announcement of that 90-day delay of those shockingly high reciprocal tariffs that he announced back on Liberation Day. And then even more recently, the positive news that we've got regarding trade negotiations, and in particular, what came out this past weekend in regards to China. So as we stand, as of May 12th, we've got broad U.S. equities down just 20 basis points on a year-to-date basis.
All right, so you really referenced the S&P there, but are there any other areas of the market, U.S. markets, that have really weathered this storm better than others?
Yeah, so very much so. So if I kind of start with the relative underperformers, the first is going to be small caps. And empirically, this makes sense. So small caps are going to be more economically sensitive than their large cap peers. So when you have any signs of economic weakness, fears of recession, that's going to have a disproportionate impact on this asset class. And that's what we've seen so far this year with the Russell 2000 declining by just about 6% through May 12th. Now, the second asset class, that's going to be large cap growth stocks, which if you talk to many investors coming into the year, these names and in particular, those Magnificent Seven names were pretty much viewed as essentially safe haven assets that would potentially weather any period of economic uncertainty better than most. And this just hasn't been the case. And the primary reason being, and we've talked about this extensively at ICM, is that many of these names entered the year essentially what we call price to perfection. And the reason I say this is if we look simply at valuations for the MSCI USA Growth Index, it came into 2025 with a CAPE ratio of about 60, which is basically in line with the peak that we saw during the technology bubble. Now, caveat, it's a much different environment today than we had in the late 90s because a lot of these large cap tech names, they're very viable companies. They've got strong earnings. But from such lofty valuation levels, it doesn't take much to shake investor confidence. Now, we thought the catalyst for all this sell-off would potentially be earnings disappointments later on in 2025, which in all reality may still occur. But in this case, it ended up being concerns over tariffs that have driven the sell-off thus far in 2025.
Sure. So how about you? Can you also address kind of the flip side of the coin? What have been the relative outperformers?
Yeah, so really two areas of note here, both of which we've been favoring in our portfolios for the last couple of years, and it's going to be value and quality. So if we look as of May 12th, we have value higher by just over 2.5%, with a 2.5% loss for the growth peers. And then if we look at quality, which we measure using the JP Morgan US Quality Factor Index, that's also returned about 2.5%. So question is, what are the key drivers here? For value stocks, really straightforward. First, you've got two traditional value sectors, those being financials and utilities. They've done relatively well so far in 2025. Both have posted positive returns. And the other key factor is going to be simply a lack of the Magnificent Seven names. These stocks have really been the market leaders over the last 2 years, but with the exception of just Microsoft and Meta, all are pretty deep in the red this year, and they still account for just about 30% or so of the S&P 500 index.
Can you talk a little bit more about quality stocks?
Yeah, sure. So their performance has simply benefited from the quality factor outperforming, something that should be expected during periods of market volatility where investors are fleeing stocks of those more speculative, less profitable, and highly levered companies. And it's really easy to quantify that. We can isolate one of the key characteristics of quality, that being profitability. And if we look at the Bloomberg's factor model, we currently look at a long short portfolio that's going to go long the companies with the highest profitability scores or exposures, and then short those with the lowest scores. That's up about 8% on a year-to-date basis.
All right, but what about outside the U.S.? I mean, this is where a lot of investors have the greatest concerns about the Trump administration's new policies. And if we think back to 2024, non-U.S. stocks were pretty meaningful underperformers in the fourth quarter, with the dollar playing a big role in that. Can you touch on this a little bit more?
Yeah, so that's probably the most surprising development so far in 2025, as we have non-US stocks, and in particular, non-US value stocks being a top performer, and the dollar weakening meaningfully against developed and emerging markets currencies. And to put some numbers around that, we've seen the MSCI EAFE Value Index, that's up more than 17% as of May 12th. And you've got about 6.5% of that gain attributable to a steep sell-off or a weakening in the dollar. And I mean, there's really a number of reasons for this, but I think one of the most notable narratives is being that we are starting to see potentially the end of that so-called American exceptionalism story.
Ryan, can you, for the benefit of all of us, expand on American exceptionalism a little bit?
Yeah, so American exceptionalism, it's essentially a view used to explain the strong returns that investors have experienced in US stocks over the last decade or so. And the rationale behind this is really that US stocks should offer higher returns because the US has experienced higher economic growth than its peers. Our currency, the dollar, is viewed as the reserve currency for most of the globe. And then we've also been the home of this massive technological innovation.
All right, so why do you think that we've seen optimism around this story really fading?
Yeah, a number of reasons there. One of the big ones is the Trump administration's policies are leading other nations to kind of accept the fact that they may need to be more self-reliant in terms of trade, defense, and technological innovation. So I think Germany is a really good example of this. So earlier in the year, they announced a commitment to increasing investments in defense, technology, and infrastructure. And unlike the US, their fiscal house is relatively in good order. So if we look back, European nations, they've been much more conservative in how much they've spent to stimulate their economies following the GFC and then the COVID-19 pandemic. And there's a good chance that this new spending, this new stimulus, could help close the gap in terms of economic growth between the US and these other developed nations in the coming years.
All right, so with all of this, what about the dollar? What's driven its sell-off recently? I mean, if you look at the Dixie index, it's down, what, about 7% for the year?
Yeah, I think that's really a combination of both fundamental and psychological factors at play here. So, just to start, I already mentioned the dollar status as the world's reserve currency. This is likely not going to change, but concerns over policy uncertainty and a general lack of confidence in the US economy following that Liberation Day announcement, it is starting to call this into question. And then kind of the more fundamental reason, it really speaks directly to capital flows. So as investors around the globe, they shift their assets from US stocks and bonds to those in their home currency, or really essentially anything other than the dollar. It's going to lead to downward pressure on the dollar because each of those transactions involves selling the dollar and then converting that into a non-dollar currency. But I really think the big takeaway around this revolves around valuation. So the American exceptionalism story, it's really used by many to rationalize that valuation premium that US stocks have held over non-US stocks for much of the last 10 years. But if that American exceptionalism story, if it is starting to fade, the question is that premium still warranted? And I think this is really playing a big role in what we've seen recently. And I also think it could be a catalyst for a longer term reversal in leadership.
All right, so let's now switch gears a bit and talk about how our investment team here at ICM is navigating our portfolios through this year's volatility, or for that matter, what you've done in similar periods throughout our history.
Yeah, so we approach volatility really in two ways. So first, we try to position our portfolios in a way that's going to be designed to protect capital in environments like we're experiencing now. And then second, we use the volatility as a source of opportunity to identify assets that are poised to perform well on the other side of it. So let me kind of start with the first point. So one of the best ways to play defense in these types of environments is really to focus on undervalued assets. So assets with less inflated valuations should provide a natural margin of safety as their prices and their valuations are typically most at risk when markets fall. So, for instance, if we just look at a single asset class, so let's look at US large cap stocks. If you go back to 1960, historically, you've gotten an average 1 year return of about 16.5% when stocks have traded in their cheapest valuation quintile. And here we're using the CAPE ratio as our valuation metric. Now, when you start in the most expensive quintile, your average return has been about 9.5%. So clearly a downgrade, but honestly not that far off from the long-term average return you've gotten for U.S. stocks, which is about 12. Now, in addition, though, to offering that lower return, expensive stocks, they also subject investors to significantly more downside risk. So a really good example of that is if you look at starting from that top valuation quintile, you've got about a 30% chance of experiencing a negative return over the next 12 months. You've got a more than 20% chance of losing more than 5%. And then you've got about a 15% chance of falling by 10% or more. And all these are essentially double the probability if you were to start out in that cheapest quintile.
All right, so let's keep going here. And what about the second point around finding opportunities?
Yeah, so while some might fear volatility and make reactionary or emotional decisions like go into cash, volatility is really what provides us with the opportunity to reposition our portfolios into assets that have sold off and have seen their valuations become more attractive. So just thinking about some examples today, we're currently keeping our eye on asset classes like small caps and REITs. But if you look back to the GFC, we opportunistically bought deep value stocks, which were historically cheap due to that unprecedented sell-off that we saw in U.S. financial stocks. Then on the fixed income side of the market, just to switch gears a little bit, volatility like we've seen, that typically results in opportunities in credit markets. So usually you see credit spreads widen as they price in that potential increase in default risk. And this was really true during the GFC. It was also true during the COVID-19 crisis. And if we think about what's going on today, so spreads did jump out in early April, but they have narrowed in just the last month or so. And even though valuations have improved from earlier in the year, they're still pretty meaningfully inside their long-term averages. So valuations are still pretty rich there. With that said, though, if the economy does dip into recession later in the year, there is likely going to be an opportunity that's going to arise in terms of the credit spread environment, and it's something that we're more than happy to capitalize on.
All right, Ryan. So I think that's probably a pretty good transition. And let's talk about the investment team's view on fixed income amidst everything that's occurred so far this year.
Yeah, I mean, it's definitely been a bumpy road in terms of the direction of rates this year. So we came into the year with the yield on the U.S. 10-year Treasury. It was about 4.6. That spiked all the way up to 4.8 in mid-January. Now we're hovering kind of in that 4.4 to 4.5 range. And all this is really driven by uncertainty around the path of the economy, and then also uncertainty around the path of rates as we look ahead. And if we think about the Fed, so they appear pretty resistant right now to cutting rates until they do see either a meaningful drop in inflation or signs of weakness in the labor market or economy. And none of this has really materialized yet. So if we look at market expectations for the Fed funds rate this year, it's changed pretty dramatically throughout 2025. If we just look at expectations from the end of the year, or for the end of the year this year, so the end of 2025, as of today, markets currently expect the Fed to cut rates just twice this year, with the first cut not arriving until the fall. But this has been as high as 4 cuts back in mid-February. And then if we go back to September of 2024, it was as high as 6 cuts.
All right, so where does our investment team stand on this?
Yeah, well, it's a pretty difficult game to predict the future path of rates, especially with all the uncertainty that's swirling around markets these days. But what I can say is that we likely won't see 2 cuts by the end of the year. It's likely going to be less or potentially even more. And rationale for that is the Fed has this dual mandate of maintaining stable prices and full employment. And if many economists are correct and tariffs do cause an uptick in inflation and inflation remains around, say, 3% by the end of the year, it's a little difficult to envision an environment where the Fed is really cutting rates aggressively into this type of scenario, given that they're really keenly focused on returning inflation to that 2% target in this post-COVID economy that we're living in. Now, conversely, though, if you were to see tariffs cause a global recession, this would likely put downward pressure on inflation as well as downward pressure on the economy, hurt the jobs market, and that would likely warrant substantially more cuts than are currently priced in. So, I mean, I guess that's a long-winded way of saying our view is generally that we won't see 50 basis points of cuts this year like the market expects. Likely, we're going to see less or more, but that's going to be highly dependent on a number of variables that at this point are really hard to predict since we brought in tariffs into the mix.
All right. So, I mean, really, let's break it down. How does this translate in your outlook for investment grade bond returns for this year?
Yeah, really good question. So despite that uncertainty around the path of rates, I don't think that any of this really impacts fixed income investors in a negative way. So if you take kind of that first scenario where we get less than two rate cuts, here you'd likely see a modest uptick in rates, which would negatively impact bond prices. However, with yields where they are today, you're at around 4.5% on the US 10-year Treasury. You've got a real nice yield cushion to help to offset this. We're not in 2022 where we came into the year with yields below 2%, which was essentially the biggest bubble in investment grade bonds that we've seen in quite some time. And we also don't see a sizable and probably the key word is persistent inflation spike on the horizon. So tariffs are likely going to put upward pressure on prices, but not nearly to the same degree that we saw during 2022.
All right. How about taking a stab at scenario two?
Yeah, so this is actually the best case scenario for investment grade bond investors. So if we remember, bond prices and yields, they work kind of like a seesaw. So as rates go down, prices are going to go up and vice versa. And then also keep in mind that bonds have historically offered a significant diversification benefit to equities, excluding, of course, unexpected inflation shocks like 2022. Now, under a scenario, though, where a global trade war does lead to a recession, investors are likely to see losses in their equity portfolio. However, at the same time, the Fed's likely to be cutting rates pretty aggressively, which should lead to pretty healthy gains for investment grade bonds, and then in particular, US Treasuries.
All right. So, with all that said, how would you suggest investors really position their fixed income portfolios amidst all this recent uncertainty?
Yeah, so I think that was really just a great time to embrace diversification. There's a good deal of uncertainty, which has the potential to negatively impact equity returns, but this isn't 2022. So those factors also have the potential to create really attractive returns for investment grade bond investors. So yields, we just think about them, they're at their probably or close to their most attractive levels that we've seen in the last 2 decades or so. And correlations between stocks or bonds, if we look historically, it's been generally low in periods where inflation runs around 2 to 3%, which is exactly where we're kind of living today. From a tactical standpoint, probably a little bit too early to enter high yield bonds, like I alluded to earlier. But it is an asset class to keep an eye on, keep it on the radar should an uptick in equity market volatility push spreads beyond their long-term average. So I think this is really kind of the same message that we talked about in our discussion around equities. Focus on assets with attractive valuations. Today, that'd be investment grade bonds, but keep an eye out for opportunities. Look at things like credit sensitive assets because volatility is what creates opportunity and the potential for attractive returns in the future.
All right, Ryan. So, before we wrap up, would you mind giving just some high level takeaways for investors who may be really concerned about current volatility?
Yeah, sure. So, just a couple of things. So, first of all, I would use this as an opportunity to evaluate your risk tolerance or the risk tolerance of your clients. Equities, they've been a great place to be over the last couple of years, but this has resulted in valuations that are pretty stretched and at pretty unsustainable levels right now. And like I mentioned earlier, high starting valuations have historically led to a higher probability of undesirable returns. And then, kind of on that note, second, I would think about how to best preserve capital during periods of market stress. And that doesn't mean go to cash because market timing and then consequently missing the recovery, even just a small portion of it, can lead to pretty disastrous results. Rather, what I would do is focus on undervalued assets where there's really less froth to come off valuations and prices. And this should help to decrease your likelihood of experiencing those undesirable performance outcomes in your portfolio. And then finally, I'd say take advantage of volatility to reposition your portfolio into assets that have seen their valuations become more attractive, which can help set you and your clients up for future success.
Thanks, Ryan. And that'll bring a close to this edition of Inside to Research. If you have questions for our team, please reach out at 888 426-4689 or via email at info@icm-invest.com. Thanks for watching.